Good afternoon, everyone, and a very warm welcome to all the participants joining us today. It gives me great pleasure to moderate this insightful session on Indian startups going global, your US expansion playbook. As an Indian startup continue to expand beyond borders, understanding the practical aspect of US business setup, taxation, compliance, and finance reporting has become extremely important. Today's webinar aims to provide practical guidance and real-world insights on these critical areas. I would like to acknowledge the efforts of our organizer, CA Dr. Raj Chawla, for continuous bringing meaningful and knowledge-driven sessions for professionals and entrepreneurs. I now like him to give the opening remarks.
Thank you, Hitesh. Good afternoon, everyone. First of all, I welcome all of you in this today webinar on Indian startup going global, your US expansion wave. Now, we have very two learned speakers for today's session. CA Manish Agarwal ji, I welcome you, sir. And CA Ritik Raj ji, I welcome Ritik ji.
Thank you, sir.
And they will cover today the following things. First is choosing the right US legal structure, C Corp versus LLC versus branches, and funding the US entity, cross border capital inflow and compliances, accounting and financial reporting, setting up for US standards, US tax compliance, federal, state, and cross border obligation, tax incentive and credits, money left on the table, and wrap up key takeaways and live Q&A. So I request all of you, if you have any query, you please post your query in Q&A. Our guest faculty will take up each and every of your query after their deliberation, or during the deliberation also you can ask them. There is no problem. So with this, I welcome all of you. Happy learning. Thank you, Hitesh.
Thank you, sir. We are privileged to have us with two distinguished speakers, CA Manish Agarwal, an expert in international taxation, US tax advisory, and cross-border structuring. Uh, with rich experience in global tax and compliance matters, and CA Ritwik Raj, who brings extensive experience in global accounting, outsourcing, audit, and international compliance advisory across multiple jurisdictions. I am sure today's session will highly informative and practical for all attendees. Without talking much, let's begin the session. I now invite CA Manish Agarwal to take the session forward. Thank you.
Thank you, Raj Chawla sir and the team for giving us this opportunity to present our thoughts on this very upcoming and the relevant topic for the professional as well as for the industry as well. So I, along my fellow partner and the host for the session, Ritvik, will cover the topics that you mentioned about the tax and the accounting compliance. So I'll just set up the brief context and couple of slides, and then Ritvik will take it for the accounting part, and then later I will also come for the taxation part. So friends, we all know, and as many of the you will be reading the news around Indian startup raising money while going US, and this is all because I think everyone will now by know, because of the generative AI revolution that has been brought in by since 2022. There has been almost billions of dollars being poured into the startups who are into the AI and technology space, and uh, many startups who want to be successful, their obvious answer of becoming or raising funding is to set up an entity in US or expand to US, because in the US lies one of the largest venture capital funds. The entire ecosystem is there. The Silicon Valley is there. The top companies, the top customers are there. There, the people also has the money to invest in your product and to buy your product or service. So that's the I'm sure the obvious reason why many of the founders are looking to invest, to raise funding to go to US as their ops choice for the entity they want to set up. And also many of the founders are also looking to change their residency and go to US, because if you want to uh, raise funding and run a business in US, it is obvious, or it is more beneficial that you should be physically present in US as well. So many people are going to US as well as the founders move their residency from India to US. So with this theme and background, we have covered some of the topics that may be relevant for the professional chartered accountants who have the clients looking to expand from India to US, or to the fellow businessmen or the entrepreneurs who are looking to expand into US. So what could be the potential complications or things that we should keep in mind from a tax compliance or an entity structure point of view? So that would be the our topic for the day, which we'll be dealing with in next 60 to 80 minutes that we will be doing now. So I'll start with first, the starting point of your US journey would be, what is the right entity structure? So let's see first uh, what we'll be covering. I think we said that entity formation, types of funding instruments, how the accounting is done, uh, how the technology is helping us to support the accounting for startups at a scale, what are the audit and documentation and the reporting requirement. And then towards the end, we'll see what are the tax compliances required, what are the incentives, M&A transactions, how it is done, and then some useful resources and the takeaways will be dealing with. So the first part is, as we say, is entity structure. So when we say entity formation, what are the typical business structures that are available if a Indian startup owner or a founder wants to set up a business entity in US? And what are the key comparative aspects from a tax point of view for those structures? So, uh, so typically there are three structures, I would say, which are called a C corporation, which is like a private limited company of India, and then there is an LLC, which is called it is a hybrid entity, which can be categorized as a partnership entity or as a corporation as well, both. And then there is an S corporation, which is available only for the US resident. So if I'm an Indian founder and if I want to set up an entity over there, it depends what are my objectives and the goals over there. Like, for example, if I want to raise the funding by setting up an entity over there, the preferred choice would be C corporation, because LLCs and the S corporations are closely held entities and investors do not prefer these kind of entities. Whereas if the objective is to set up an entity for the time being for a personal holding company and not to pay significant tax, then you could go for an LLC, because over there it is a pass-through entity. But also, if you're looking for like an entity structure which is safe from India tax point of view, from the India POEM risk and the double taxation risk minimization, then C corporation is something. So it depends on the choice of the factors we have, and you need to discuss with the founders and the owners and the ultimate team that what are their goals, and basis that only we can determine that which entity structure is legally correct for you. There is no a one single answer we can give to anyone that okay, you want to set up an entity. The answer cannot be a C corp in any always. In that case, it could be a C corp, it could be LLC, it could be S corporation. So depending on your goals, it could be, like for example, S corporation can only be formed by the US residents or the citizens. But like if I'm a Indian owner or Indian founder, I cannot go for an S corporation. So the choice for me is limited to the C corp or the LLC if I'm forming an entity as a resident, Indian resident. So these are some of the factors, as I said, like what is the tax rate? A corporate tax rate is 21% flat tax rate, whereas for an LLC, the tax rate is generally dependent on who are the ultimate beneficiary or the members of it. Also, LLC, there is one advantage that you can opt for tax treatment as a corporation, despite LLC default tax treatment, let's say, is for example a partnership or a disregarded entity if it is a single member LLC. And for a multi-member LLC, the treatment can be a corporation or a partnership. So if corporation means it is taxed as a private entity over there. And for example, I said VC institutional funding. C corporation is always a preferred structure, whereas LLC, VC don't do much of a prefer. Similarly, for some tax incentives like a 1202 eligibility, corporation is only allowed as an incentive over there. So if you want to target those incentives, that incentive is not available to LLC. So with a combination of these factors, you determine which one is favoring, which structure is giving me the best advantage and leading to my future goals. And basis that we decide the entity structure. Then the other question which normally comes to us is what are the states in which I should form mine? So under the US law, each state is different for the company formation purpose. Like many of the professionals would be over in India, there is one single law which governs the formation of the entity in India, which is the Companies Act 2013, and there is a one single regulatory body called Ministry of Corporate Affairs. But in US, each state has its own corporate law and each state has its own Secretary of State, which is the regulator for the entity setup in US. The process is broadly the same, but each state has its different laws, both in terms of the corporate laws and the tax laws. And depending on my objective, if it is for the flexibility in the corporate structure, corporate bylaws, and preference of the investors, and from a tax point of view, or from a privacy point of view, like if there is public disclosure of the shareholder is not required. So, based on those factors, we determine which state is right for you. For example, one of the most popular state everyone would know is the Delaware is the state which is most of the companies form their head office over there. The reason being it has a very flexible corporate law. VCs also recognize this state and is widely accepted. There is a privacy. The beneficial ownership requirement is not there. There is no state income tax as well. And some other popular state, as I said, is like Wyoming, Nevada, Texas, and Florida because there is no state income tax. California is also popular because it is very close to the Silicon Valley and the investor, but it is a bit expensive in terms of the yearly maintenance cost. But again, a very popular jurisdiction for setting up a entity in US. Yeah. Then I think we move to the next topic, which is what are the kind of funding instruments available typically when you go and set up an entity over there, you uh, achieve the minimum viability product and then you go to the investors. So what are the different types of instruments that you expect to be there? Because in US, you should be aware that what are the instruments in which investors generally invest. So typically, it could be under three broad categories. One is the equity or common stock, which we call, or as a preferred stock. Preferred stock is like preference shares in India. Then the other is the convertible notes, which is like a hybrid convertible instruments. And then other is also a safe from, which is also a convertible instrument. But at the moment, it is neither a liability or not a equity. It's just that a I would say a hybrid instrument which will convert to equity at a subsequent stage, not at this. So convertible note or safe, I would put it in one bracket as a convertible instrument and preferred and common stock as an equity one. Their terms typically vary that in safe instruments, there is no debt, no instrument, and no maturity date. Valuations are there. I mean, of course, the conversion ratio is given at what liquidity events are there at under which they would get converted. So, a safe instrument is, I would say, one of the most popular funding structure right now in the US, and it's widely used by the Indian owners and the founders to raise the funding in US. And from a tax point of view, at the time of issuance of safe instruments, there is no tax issue. But from a FEMA point of view, as long as the liability sits in the US entity's balance sheet, it doesn't impact Indian FEMA law. But yes, if at some point of view we feel that Indian entity is somehow the party to the as a guarantor or as a subscriber to the agreement, then obviously the FEMA implications would also will come into play. Convertible notes similar to SAFE, they are debt instead, but there is proper interest rate and maturity defined, and it converts to equity at next qualified financing round. From an India point of view, of course, if FEMA rules would apply, if it is a debt in nature, ECB regulations would come into picture, and also uh, DTAA interest rate delay would also come into picture if we are paying interest from India or the promoter is paying some interest at its guarantee level from India. Preferred stock or common stock is pretty much a straightforward equity route. I mean, uh, there is no tax at the time of the issuance, generally 5627. But yeah, if the Indian promoters are involved in the US entity and there is an exit you want to take in future, the capital gain tax implications in India also need to be considered if the person is the or the owner is the resident of the India under the Article 13 of India US WTT. So yeah, so with this, I'll hand over the session to my uh, partner and co-host Ritvik Raj for taking up the accounting issues, and then I'll take charge again for the tax matter. So over to you, Ritvik. Hi, Ritvik, you're on mute.
Yeah,
Yeah.
thank you. First of all, I would like to thank Raj Chawla sir for giving us an opportunity to present today on this topic, US expansion. And thanks, Hitesh, for moderating the session. And today, just now, we saw what an insightful Manish has presented about, the US cap, why the founders they are moving to US. If you need some funding, then obviously you need to go to US, set up a company because more or less that there's a compliance purpose that the people are setting up the companies, entities in US, Delaware regions, and other to get the funding and then to set up the company and expand their business. That's the real reason. And Manish also suggested he shared his wisdom on right now, like what kind of entity you should set up. And it all depends upon your goals and ideas, like what kind of entity, whether you need S corp or C corps, depending upon the taxation. So now going forward, I'll present the scenario for the accounting aspects, why accounting is also crucial if you are setting up a company. Then you need to do a proper accounting so that you are tax compliant. Okay. So for the taxation purpose, accounting purpose, and the regulatory purpose, your books has to be as per the US GAAP, and your book has to be solid, sound. There are no irregularities. So I'll cover here the topics relevant for the accounting, like you know how you can set up your accounting, what are the softwares on which you can work for the accounting purpose, then some accounting aspects that is very much required if you have a opening your books, maintaining your books in the US, other global countries. Then the industry specific, like certain scenario, certain case studies where how there are certain cases affecting depending upon the sector wise, or whether it's a hospitality or it's a SaaS based. Yeah. Then also I'll discuss about the more interesting topics here, about the accounting softwares you should use for the accounting purpose, the filing deadlines, everything. So I'm just sharing my screen here. So accounting for startups. So as we see here in India that we maintain our books on cash basis, on accrual basis. Okay. So similarly in US also, if you're maintaining the books of account, you can maintain your books on cash basis as well and your accrual basis on as well. For the US, it's like it's allowed for the taxation, but it's allowed that up to $30 million you can maintain your books on the cash basis. But I'll suggest you should maintain your books, on the accrual basis because that gives a clear picture of your accounting. So that is not that if it is yes, we are in US, we can maintain the cash base, but to get a better picture, you need to maintain your books on accrual basis. Later, you will move on getting funding, you will be expanding. So for all that, there are certain factors which will come later on, but why not to start doing it right now? So that's the reason I suggest to go on with the cash basis. Then similarly, like in India, we have the Ind AS, the I gap we have here. Similarly, in US also, we have ASC. So on that basis, that's a standard prescribed by the ASC to maintain, to follow certain standards of books of account we have. So your books should be gap aligned so that there's nothing that you are aware of the standards and maintaining the book as per your gaps. Then monthly you close your books of accounts so that your all the bank categories or they are categorized transactions you have in the bank, they are categorized. Okay, that gives a clear picture. And after this, if you're maintaining the books of account, then you should maintain your transfer pricing documentation for intercompany fees. Yeah. So, like, the accounting standards, they are prescribed by FASC, FASB. Okay, there is Financial Accounting Standard Board, which from where you can see what are the standards prescribed. I can take you up to there. Just wait on. See, if we can go Google and just type FASB. See, this is the site of FASB, US FASB. See, this is Financial Accounting Standard Board. Okay. These are the standards here. If you name it, you can want to see ASC, which are tool accounting standard codifications here. You need to accept this. Something has problems coming.
You need to press accept, I guess.
Yeah. I was not able to because of this cursor. Yeah. So you can see here, this is FASB. And here you can see where you need what kind of standard if you need in revenue. This is ASA 605. And you can go to this website here, read whatever it is coming here. Then if you want to go for the liabilities, equity, so we have all standards here. So you can visit this website and get a thorough understanding regarding the whatever the accounting standard codifications. Just like we have India, similarly it is here in the US cap. So there, and I'll not be taking out whole because we don't have time does not permit to take each and every standard. Just I'll tell you about a brief about the certain gaps which we have found in the Ind AS and US gap. So coming to revenue recognition, when we had when we have a normal gap, there was just how to recognize revenue. It was that there's consideration should be there, and so services has been performed on that basis. And on that basis, we recognize the revenue. Then came the Indias. Indias prescribed the five steps model for the revenue recognition. That is like there should be a contract. Okay. Then if you have a contract, there should be a performance obligation. There should be a transaction price. You should be able to map the transaction price with the performance obligation and recognize the revenue. So these are the five steps model for recognize the revenue in India. So similarly, in the same US GAAP ASC 606 also, we have a similar type of five-step models. And the gap, US gap is very much inclined to the India's adjustment. However, there are certain changes in the US, for example, like on the basis of we have SaaS-based revenue, SaaS contract, IT. So in IT, what generally happens, there are certain, you get a contract and that's on the basis of recognized revenue on the milestone basis. So then there comes the concept of deferred revenue. Deferred revenue is something that you have received the revenue, but that is not relevant to this accounting period. So you need to defer it. So that is, you have to charge it proportionally over your accounting periods. So there's a concept of deferred revenue in this for the SaaS contract. Then you have leases. For India's prescribe 116 for the leases. So similarly, we have ASC 842 what the lease is. Now, in this lease, we recognize the lease liability here. And then for the lease liability, if you have, for example, if you have taken uh, an office on rent, okay, so you need to recognize a lease liability for it, okay. And that's the lease that you have taken, that's for more than 1 year. So you need to recognize the lease as well as RU asset for that office. And since you have recognized asset, you need to charge depreciation as well. And the liability which you have recorded, the liability will keep on decreasing year after year after year. And when the lease period expires, the lease liability will be nil. So similarly, we have this concept in ASC as well. That's the same similar approach in this. Uh, in the India's, what are the methods allowed for the inventory? That's FIFO method, weighted average method is permitted here. But these are both the methods FIFO and weighted are permitted in US GAAP as well. But there is also LIFO method, that is last in first out. That's also permitted in certain cases. Then another interesting is the development cost. You must have heard about the intangible asset capitalization of the intangible assets, where there is research expenses and the development expenses. So in India, what happens that the research expenses, I mean India, I'm talking about India's. So what happens in India is that all the research expenses, what we incurred, they are charged to the profit and loss at the the same year when it is incurred, and development cost is capitalized. But in the US GAAP, okay, ASA 350. The concept is little bit different here. Or yes, you will, the research expenses, whatever it is, you will charge those to the P&L account. That is, will charge it expenses. Then comes the development cost. So what happens there? There's a very, very narrow development cost there, because most of the items there, US says, the SC 350 says that you just charges to the P&L account. So there's a very less and narrow thing left for the development cost to be capitalized. Because whatever, if you have something, you have thought, yes, you have need to that has been come, that asset will be recognized, there's a future viability of it. And then whatever the research expenses and the most of the things coming in development is coming, that needs to be capitalized, and little amount is left for the development cost to be capitalized. Then here comes again the goodwill, which is amortized over the useful life, maximum 10 years. And there, what happens in the US GAAP, it is not amortized, subject to this annual impairment testing under AC 350. Yeah. So I'll come here again. And there are certain things to like you have seen how to maintain your books of account in the U. So in India, here we maintain the books of account in Tally or Busy or some other software. And now most of you must be having a thought, yes, it is a you have heard of the QuickBook, and so you can maintain the books of account in QuickBook. But there are more other softwares apart from this QuickBooks. There are Puzzle, Digits, Basis, RAM, GL Intelligence, and I'll tell you there are a lot of softwares there. And some are industry specific as well, the softwares. So the cloud-based software, like you have QuickBooks, you have Zero, and now it's the time of AI. So you have Puzzle, Digits. So Digits is another software which has been funded by, the AI. ChatGPT's founders have given funding in this Digits. Then you have Puzzle, which is an AI-based accounting software. So recently, a client came to me, and said, we don't need accountant, because we have AI-based accounting software, that is Puzzle, and we are maintaining that Puzzle software, and that's very nice. Say all the transactions are flowing correctly. We have linked into our bank account. Mercury, and then all the transactions are flowing and we are happy with it. So we don't require any accountant for it, to manage our books, because that puzzle, that categorizes the books depending upon the what's the nature of it, everything. That's very good. If you're maintaining it, that's a good software. But there's a brainchild as well. This is needs they need a person as well, to review a books account. I understand, but there would be a lot of things. You need a second hand review as well. And there comes the role of an accountant. By who has made this puzzle? It's the we human beings has made the puzzle. And obviously there would be a chances, of making error as well. So that's required. There's a requirement for second level review to see whether the accountant, whether your transactions are flowing correctly, it's going to the right GL, it's going to the right balance sheet, you have categorized it. So it's something that you cannot entirely depend upon this AI based software. See, Zero is accounting software which is widely used in Australia. In US, it is mostly we use QuickBook here for small case scale business. Then we have Oracle NoteSuite, it's advanced version Oracle. Then Sage is an in ERP software and smaller to the ERP. So we have this Sage here. So by this, with this, these are the accounting software where you can manage your books of account depending upon the volume of the business you have. So I'll tell you now, like, what are the things, how to categorize your books of account, how to do it. So first thing, need to have your books of account that should be linked to your banking. That's you can have Mercury breaks or any other banking channels. You need to link your QuickBooks with that bank account. So similarly, the transactions will flow into your QuickBooks and you can categorize it that way. For the HR, for the payroll, you need to have Dex or any other software ADP so that the transactions you can
I
see
think you are
whatever
showing
the
different slide. You are showing the different slide.
yeah
I think
slides.
no, it's moving. It's different.
Yeah, I know. I
The
maybe.
text slide you are talking about is different. What we are presenting. If you go
Hmm.
up, yeah, this one.
Hmm. So that is how
Uh,
you can link your bank account, you need to link your softwares, HR softwares, and get this proper accounting. Now I want to talk about, the certain accounting concepts which is used industry wise, how certain concepts they differ industry wise as well. So with this example, clear based example, I want to take on this SaaS tech. If you have a client and it's a SaaS based technology, so what are some case study can be also be taken upon this? So I would just want to take in. So a Freshwork is a company, and it's an Indian company which wants to list it, which in Nasdaq IPO 2020 wanted to list its company here. And they wanted to require when you list something, you need your two books of account use that should be converted as per the US GAAP income. So what they found, when they were trying to list it, oh, they found something that capitalization. That one they had some assets and they wanted to capitalize those assets. As I told you, there was intangible assets. There's in US, there's a very less scope for capitalization. So in India, what happened? They had capitalized a lot of amount, huge volume of account, which they had to devalue and charge to the P&L account. Then they found some irregularity regarding the stock-based compensation AS 718. So, okay. So that thing led to what happened? That led to the delay of approximately some 4 years when them to get the accounts listed. And what happened? They had to incur huge amount of to pay to the big four. So that's what I'm saying. There are accounting gaps here, if here, and it is industry based as well. So you have to be very much sound of which industry you are operating, what kind of accounting is required. This is a SaaS based. Okay. Then another case study I want to give you regarding a case study which is very much relevant if you are like a hotel industry. Let me see if we have this slide or not. Okay, Joe, I've not covered it, but I'll cover it here. So, like, if you're operating a restaurant here, then you know you have the accounting software. You can maintain your books of account in QuickBook. Then you need to have a Dext. Then you need to have your other software. For the payroll software, you also need like Gusto. That's a good software for the maintaining the payroll. Okay, so once you link your bank account to the Mercury or other to the your accounting software, the transactions will flow and you can start categorizing those books of account. With the Dext, sorry, not Dext, with the Gusto, you can manage your payroll. So there are various softwares which can use depending on the industry type. Okay, one salient accounting feature is there that the tips. So there bartenders, for to them you pay the tips, and that tips is not an expense. That's a payable amount. So you need to very much particular that tips doesn't go to your expenses. The tips will always be a payable amount. So this I've discussed here, because Manish already spoke about ASC 480 safe instrument, which is something not readily converted into equity right now, but it is something like when you receive the funding series or CSV, then it gets converted into equity. So this is something which you have to keep in mind when you are maintaining the books of account of it. I spoke about internal use software as well. Then there are certain other standards that's not so, but you need to have some give emphasis on it, like ASC 230 cash flows, ASC 820. This is fair value measurement of where there is ASC 805 business combinations, ASC 326 credit losses, contract costs. This I have discussed. So these are the accounting softwares like Accounting Core. And you have QuickBook accounts, which is managed by the Intuit Online. We have Sage, NetSuite, this is the accounting software. Then you have bank for the banking, you can do your banking on Ramp, Breaks, Mercury, Relay. For payroll and HR, that's Gusto, Rippling. For sales tax, Avalara, TaxJar. For reporting MIS, it's Reach Reporting, Fathom, Giraffe. For the PNA, this is for the FPNA software. For the FPNA, if you needed something, this is a very good tool for the FPNA purpose. So you see, there's like wide scope of tools, accounting software for managing your books of account. So in India, if it's a small business, you rarely just to go on tally and just maintain it. But it doesn't happen in the US. The credibility is more required. The accuracy is very much emphasis is given to that. So you need to have a proper tool so that everything goes flow correctly. Uh, Covering this sector wise, a very case there's a very case study which is coming to mind, which I want to disclose it to you right now. That's something like, if you have any of your client or you are managing the books of account come in the healthcare sector. So in healthcare sector, there is a law there called HIPAA. So what is HIPAA? That is basically a protection for the patients, like whatever the data you have regarding the patients, like if it is something like their date of birth, name, what kind of illness they have, so all that's in US, that is a very protective, that you cannot reveal it to anybody else. Even you have your husband, if husband is having any kind of illness, it is not required that the wife has to know what kind of illness my husband is facing. So in US, they give very much concern and for the privacy for this. The healthcare, it's hospital, clinic, or anything as anything. So it there, a contract is signed. Okay, that called BAS. So under this, that the confidentiality remains between the patient and the hospital, that they're not going to reveal anything, what kind of illness the patient has, to any of its family members, unless that person, the patient, gives the consent, who are the persons that they should know about his illness. So similarly, I want to talk about why I'm taking up this point, because the accounting software. So you should have an accounting software for this, like QuickBook. QuickBook has given a disclaimer that it is my accounting software. It is not a healthcare software. Imagine. So you're getting it. They have openly gave a disclaimer. It is my accounting software, not a healthcare. So in that case, they have protected themselves that if you're managing your books of account in QuickBooks, that's not my responsibility. And if it is healthcare, if I'm talking about the healthcare, that if it is something healthcare and you are managing the books of in QuickBook, then QuickBook is not responsible for it. That's an open disclaimer. So now the question comes, how are you going to maintain the books of account, the billing, everything related to that patient? If it's a hospital, it's a small hospital, they're going to maintain the books of account of the patient? So there's another option. Okay. So there are other softwares apart from it. So you can maintain your books of account apart from other software, apart from QuickBook. Now, there comes the audit reporting documentation. So you know what is the reporting? It consists of balance sheet, statement of cash flow, income tax, P&L notes to financial expenses. Similarly, what we have there in India, so similarly it's in US as well. But that all has to maintain as per the ASC. Now, another salient feature is that you do not, as we have in India, that if it's a privately limited company, if it's a company, audit is required. In It is not such in the US. Their audit is not mandatory. It is mandatory only for the public listed company, and it's mandatory. If you have achieved certain threshold, there's a threshold limit. On that basis, you have to audit is required. Apart it is if it is a small business companies, audit is not required there. Then if the founders, if the investors, if they want that audit should be done for their books, then it's something a voluntary basis audit can be done. There you have another concept like review, the full review, limited review, specific review, agreed upon procedures. So on that basis, you need to do your accounting, you do your audit, review of the books of account. So those are the things, something. So that's what I'm talking about. If it says something funding is required, the investors want the funding to be, then audit is required. Apart from like review engagement can also be done to Series A, small lenders, board reporting. Then there is a compilation engagement that you need to compile your books of account. If it is a pre-seed, that's a level, pre-seed level, bootstrap level, there the investors they may require it. The angel investors they may require to have a books of account to get the numbers. Now another question here come that till how many years we need to maintain our books of account. So it's something, it's not prescribed so much for everything because it differs upon what kind of documents you have there. Okay, what kind of compliance, what kind of law it is. On that basis, it is required for how many years you need to retain your books. Well, for in general, like it depends on 3 to 7 years. Like if it is a bank statement reconciliation, it's 7 years minimum. Invoices received 7 years, payroll records 4 years. And if you have like the minutes of board resolutions, incorporation certificates, like captable, this is something a permanent document that should be retained as long as the company is there. Contracts and agreements 7 years. Federal tax returns almost permanently minimum 7 years. And then transfer pricing documents are there, that is counterpress 7 years. Yeah. So now this is all I talk about the accounting and things have to be done. And now I've request Manish to take this session forward.
Thank you, Ritvik, for I was very insightfully listening to your conversation on the examples you gave for the US listing and other things. Thank you for enlightening us. So, friends, having gone through the importance of the accounting and the significance of your books of accounts, we now move to the next important part for a startup journey when you become a US entity or you intend to open a US entity is the tax compliances. So, you need to also be compliant with your laws, tax laws specifically. Also, there are other laws, but we will specifically discuss with the tax laws. So when we say tax laws, what do we mean here? So it generally means your federal income tax laws. And is my screen visible? Oh. Yeah. So when I say tax law, what do I mean is we need to comply from both from India side as well as for the US side of the laws. So when we say India cross-border compliance, like FEMA, if you are making an investment outside India, you need to comply with the FEMA ODI regulations in terms of like 400% of your net worth and yeah, your 60 days reporting requirement and whatever instrument you are investing through, you need to uh, comply from a FEMA law point of view. And also, India capital gain tax requirements on if you have made investments or as an Indian resident in the foreign entity, then whatever capital gain tax implications, if any, you would need to comply there on future. Also, if you hold interest in foreign entity, then you need to report that in your India income tax foreign asset schedule of your return of income or foreign source income if you're getting any interest or dividend income. Similarly, from a residency point of view, we need to see whether that foreign company would be considered as a poem of India or not. Basically, if it is controlled from India, and also if there is a flip structure like Indian entity holds in US, or if there is a reverse structure where US entity holds structure in Indian entity, whether we need any RBI approval for these kind of transactions or not. So this is relevant in case of a structure like where we are reverse flip or flipping the structure where Indian entity is held by a foreign entity. So depending on that, we need to analyze also the India FEMA and income tax compliance requirements as well. So from a US point of view, this is important. What are the key compliances we need to file? One is your Form 1120, which is the corporate income tax return. This is filed by 15th of April of each year, and there is an extension allowed automatic by wherein you can 15th of April deadline becomes 15th of October. So every entity formed during a calendar year. So in US, generally the tax year is the calendar year. Unless you elect for a different year, the default tax year is the calendar year. And as I said, you can form a company or you can form an LLC with a partnership structure. Then the tax return applicable is 1065 and it is due by 15th of March. And also you need to make similar to India, like estimated tax payments, which is advanced tax, so that you don't end up paying if there is an underpayment of tax at the end of the year. There is no tax liability for the underpayment of the tax liability. Also, in India, you don't have a state income tax return. There is only one income tax return, which is ITR 6 for a company or ITR 1 to 4 for a individual. In US, the income tax is also a state subject. So apart from your federal income tax return, in whichever state you has operations, which is in the next part we are discussing nexus. If you have nexus in the form of physical operations, employees, or your sales in a particular state exceeds a threshold, then you are considered as having a nexus in that state and you are supposed to file the income tax return of the state as well. So in US, you file federal return plus state income tax return. And that state income tax return depends on the factors like where your company is incorporated, in which state you are carrying your significant business, what are the key states in which you are making sales, and what is the state threshold, whether you have any employee stationed over there, whether you have any agent in the particular state, or whether you have any physical warehouse or something like that. So depending on that, you need to determine whether I need to file a state income tax return as well or not. Then apart from income tax, you are also supposed to comply with the payroll compliances. So payroll compliances, like in India, we have EPF, and Employee Provident Fund and Employee State Insurance, ESIC, and other things. So in US also, it is Social Security or payroll taxes that we have. And in US, like for other taxes, payroll taxes also run federal and state. So as an employer, I'm supposed to comply first the federal withholding tax, which is like TDS under salary for Indian employees. So similarly for US employees, I need to do a federal tax withholding and then also do a state tax withholding. And then there is a social security tax. Like PF in India, it is called social security, and the name of the tax is called FICA, Federal Insurance Contribution Act. And there are two components to it. One is employer contribution and other is employee contribution. So both employer and employee contribute to the social security scheme of the government. And then there is also a state social security, which is sometimes called as state unemployment insurance or state disability insurance with the different names. So, and also the payroll in Texas. Then I need to, depending on the where my employees are working and where they're like.
Can you please repeat? आपकी ना आवाज आनी बंद हो गई थी. Network relation.
Okay, I'll repeat. So, as I was saying, uh, multi-state payroll compliances, depending on where my employees are based out of, I am required to take compliances in more than one state if my employees are situated in more than one US. For example, if one employee is in California, other is in New York, and other in Texas, depending on how they are working over there and my company's presence, I will be required to take registration in those states as well. So in US, it's just not always the federal compliance, it is always federal plus state level of compliances which I need to factor in. So this is a summarized due date chart. I explained the main reporting form, which is corporate income tax, state income tax, and payroll forms. These are other forms which are a part of my income tax return and required to be formed. So 5471 form. This is one of the very complex form. It is filed when US entity holds 10% or more in a foreign entity. The other form is Form 5472. This is applicable if US entity is owned 25% or more by a non-US person. So this is also filed along with 1120 or the corporate tax return. Then there is form called FBAR, Foreign Bank Account Reporting, or FinCEN 114, wherein if I am a US resident and I hold bank accounts in foreign country, I am required to report the details of all my foreign banks, like branch, maximum balance, account number. So this could be applicable both for company as well as the founders who move to US and they are filing their individual tax return. So they are supposed to file the FBAR reporting along with their tax return. Then also FATCA form 8938. This is also applicable on individuals. So for particularly for founders who move there, wherein they need to report all their foreign accounts and also the interest income, dividend income, or capital gain, or the maximum portfolio balance they are getting from their foreign reportings. Then also this is some supplementary information which you need to give if US entity pays more than 100K in terms of transfer of property for cash or other consideration. Then there is a information reporting in Form 926 required. This is also formed as a part of your income tax return generally. Now, this is very important area, tax incentives and credit, especially with this age of technology and startups coming out there. There are a lot of incentives there provided at the federal level and at the state level. One is which is very popular and recently made very attractive by the One Big Beautiful Bill of US, is the qualified small business stock. It is
Your
similar
PPT is
to,
not visible.
sorry, let me reshare it. Is it visible now?
Not yet. Yeah, it is visible.
Okay, sorry for that. So this recently this provision in the US IRS code called 1202, qualified small business stock. So this provision allows that if you make a sale of a stock in a company, and if certain conditions are being fulfilled, then the capital gain realized on that sale is 100% excluded from your taxable income. So this is a very powerful provision wherein founders of the company who have put efforts to nurture the company and to grow the company, and when they make a sale, uh, it is to incentivize them that there is no tax on the hard work that they realize through sale in the form of capital gain. So what are those conditions, first of all, to qualify for this zero tax? One is that this benefit is available only for a corporation. So that is what in the initial slide I mentioned, that if we are targeting for a zero capital gain tax at the time of exit, a corporation is a suitable mechanism. And the company should be a small company. As the name suggests, it's for a small business stock. So the small business means the value of the assets at the time of issue of shares should be less than 75 million. Earlier, this limit was 50 million, but in 2025, this limit was increased from 50 million to 75 million. And the stock should be issued to the founder as a primary issuance, not as a secondary transaction. And the shares must be held for a period of greater than 5 years. Okay. And this is eligible for the businesses in the technology, manufacturing, and life sciences, not services, finance, hospitality. These businesses are not eligible, but tech sector is in particular allowed. So finance like banking is not allowed for this stock. Similarly, hospitality sector is not eligible for qualified small business stock. So they genuinely want to promote the tech and certain sectors which are capex heavy and but small, so that there is no capital gain tax at the time of exit on the promoters. And so there is tier based criteria. Let's say if I do not meet the full 5-year holding period criteria, then what happens is if you hold the stock for 4 to 5-year period, then 75% of the gain is not taxable. If you hold the stock for 3 to 4 years, then 50% of the gain is excluded. Also, as I said, we need to be mindful of the state tax implication. This 1202 is the federal exclusion. Some state, especially the California one, does not allow the this QSBS deduction. So again, a very relevant question when you incorporate a company, where you incorporate a company, whether we need to keep in mind the future exit point of view. If I suppose incorporate a company in California, let's say I don't pay a tax on federal law because of I'm qualifying for this 1202 exemption. But under California, I may be required to pay 8% or 11% tax depending on the tax rate I'm falling into. So the state choice become very relevant here, and if I'm planning for a future exit. And there is a limit on the exclusion which I can claim on the transaction, which is 10 million or 10 times of the cost basis. Greater of these two, I can be claimed per issuer per taxpayer. Okay, so and this is not a lifetime limit, but this is a transaction wise limit which I can claim. So certain planning tips for as I said, you can exclusion. If I'm an Indian founder or a foreign founder, 1202 exclusion is available to non-US person, yes, but there is some residency analysis required. And also, if you are selling before 5 years, there is also a rollover mechanism. If you make a further reinvestment within 60 days, you can still get the benefit. And then for some instruments like warrants, options, and convertible instruments, which gets converted to the stock, whether the 5-year holding period would qualify or not, there is some still gray area. Guidance is awaited on this. But yes, this is a very powerful tool of taking a zero tax benefit at the time of exit. Moving on to the certain other tax benefits and credits which we have. The recently, as I said, the one big beautiful act, which is OBBBA, which I am referring here. It gives lot of incentives to technology-based manufacturing business and startups. One is and R&D base, that you can get a 100% deduction of your research and development expenditure incurred within US. Earlier, this deduction was allowed in 5 years for domestic expenditure and in 15 years for foreign expenditure. The foreign one still remains 15, but the domestic R&D is now fully allowed in the year of expenditure. So you don't need to amortize it over the 5 years. This is a big relief for the US based companies incurring expenditure within US. So this incentive was to promote the domestic US economy. Then also a bonus depreciation feature has been there, wherein if any asset which is of the life less than 7 years and it is in the nature of for the business purpose, or like equipment or anything, you are incurring expenditure on that. If that asset is purchased on or after 20th of January 2025, 100% of the depreciation can be claimed. So this is a very powerful incentive given that you can claim 100% depreciation. No need to amortize it over a period of 5 years, 7 years, 20 years. Immediate expenditure benefit. Then also for S Corps only, this benefit is there, which is called QBI deduction, Qualified Business Income Deduction, wherein you get a 20% of the income is given as a deduction to as a pass through to the owner of this. So we've discussed QSBS, R&D expenses, bonus incentive. Now there is another one, although this opportunity zone is no more relevant after 31st of December 26, but the law is that if you realize any capital gain and if you make reinvestment in the form of real estate development in any upcoming zones which are notified by the IRS that okay, these are backward areas. If you make investment in these areas, then whatever investment that you make there, that portion of the amount is reduced from your taxable capital gains, and only on the balance you are supposed to pay the capital gains tax. So this is the mechanism, but this window is closing with 31st December 2026. So I'm not discussing much on this because this provision may not be very relevant now. Opportunity zone. So FICA tip credit, it is relevant especially if you are from a hospitality sector and restaurant sector, wherein if on the tips you pay any tips is particularly given like gratuity or tips like in restaurant. So if an employer pay tips to his employee and also he pays social security on that tips, so government gives a benefit to the employer in their IRA, in their tax return filing, that okay, if you are paying social security on the tips, you will get a credit in your income tax return. Now, okay, this is the some summarized deductions which I discussed. 12 or 275 million and threshold, 174 R&D expensive, 100%, bonus depreciation, QBI qualified business income, you get a 20% deduction in a permanent way. Tip income deduction. And also this is very important, estate tax law. So this is also very important. If you plan to become, let's say you become a US founder and you become very successful and you made a fortune of, let's say, 50 million, $100 million, and you become a US resident. Now, under the US law, if you are a US resident and upon your death, or if you make a gift of asset up to 15 million per taxpayer, that gift or inheritance is considered as tax-free in the hands of the recipient. So if you are a joint filer, you can transfer up to 30 million as a US resident to your children or to your loved ones without incurring any tax implication. So this is a very big relief, that up to 30 million and a joint return, you can transfer the assets to your legal heirs on a tax-free basis. Now, this is very, again, a hot sector, and you would see the news happening more recently, as recent as Anthropic going for an IPO of $1 trillion, OpenAI going for as high as 800, 900 billion, and many IPO transactions are happening on a SaaS companies. So when this IPO happens, what are the transactions or the tax implications from a US law, which we'll discuss this briefly. So, typically, in a SaaS company, the one of the most significant asset is the founder or the team or the core team that develop the product or develop the service. So, and when a founder and the company goes to IPO, generally to retain the talent, what the structure is that the founders of the company are being told that, okay, if you earn certain objective after company becoming listed, let's say revenue target or profitability target, we will give you additional compensation. Let's say apart from your IPO exit, let's say $75 million, $100 million. So these are generally called as earnouts commission, which is contingent consideration. In India also it is given to like founders like earnouts, which is like a contingent consideration payable upon the future targets being achieved. So it is very controversial in US or even across the world whether these earnouts payment are in the nature of capital gains or they are in the nature of salary, because it is dependent on your future service being delivered. So uh, uh, if it is in the nature of capital gain, it is taxed at 20%, whereas if it is treated as a salary or an employment compensation, it is treated as a taxable at ordinary income at 37%, because these are generally high amounts. So depending on the factual analysis of the agreements and for which purpose the payment is being made to the founder for earnout, we need to come to a conclusion that whether it is a taxable as a capital gain or taxable as a salary income. Then there is another term called tax-free reorganization. Like in Section 47 of Income Tax Act, a merger which fulfills the condition of Section 21B. In US also, there is a section called Section 368, tax neutral reorganization, wherein if all the conditions of these sections are fulfilled as a merger, then there is no tax on the transferring the outgoing shareholders of the amalgamating company or the merging company, and there is no tax on the merger itself. There are certain conditions like 60% of you can pay in the form of non equity, and 40 so means 60% you can discharge as a cash consideration, but and whereas in India it is like minimum 75% has to be equity and 25% only cash. So in US the thresholds are a bit higher, and there is also that at least 40% of the business should be continued by the previous owner. In India it is 75%. So depending on whether these conditions are being fulfilled or not, the merger can be considered as a tax neutral merger. Then golden parachute payments, it is like if there is a change in control of the company and there is a payment being made to the outgoing founder or CEO in some cases, then those golden parachute payments are taxed at a very high rate. Generally, golden parachute payments are structured in the CEO contracts to protect the interest of the CEO or the founder, that okay, if the new management comes in and they want to let go the old CEO, then he is entitled to, let's say, 5x or 10x of his base pay. Okay, if he's entitled to that, then this is there. But there is an additional 20% tax called excise tax on the recipient, and which is very high tax rate in some cases. So we need to see how the if we are making the payments to the founder, one-time payments, how it should be taxed or structured in a manner that it does not attract inviable tax consequence for both the parties. Then often M&A controversy issues, some like whether there is an economic substance in the transaction or not, and whether the transfer pricing aspects, intercompany loans, and these are the transactions because they become very prominent, because if two companies merge, there are related party transactions between one entity and another. So all these transfer pricing documentation and intercompany pricing, these issues are typically looked upon by the IRS as well. So we need to be very mindful of these issues. Now, this is also a very similar to M&A, which I was discussing. SPAC is something, SPAC listing is kind of a reverse merger situation. In a SPAC listing, what happens is there is already a listed company in place on the NASDAQ or NYSE, and that company has now 2 years or 3 years to find a suitable potential target who it could merge into itself. So SPAC company is a blank check company or a shell company, but it is listed on the stock exchange and it is in search of potential target companies which meets its objective. So once that objective is being met, what happens is that the target company gets merged into the SPAC company, and the SPAC company after merger loses its identity. But the end result would be that the unlisted target company would get listed on the stock exchange. Instead of filing a papers or regular IPO process, a SPAC IPO is a speedier one process, and it takes less time for the investors and for the founders to get listing on the stock exchange. So some key tax issues here is that whether the uh, deduction which we discussed QSBS would be allowed or not under the SPAC listing or not, whether the insider trading rules will apply here or not, whether S corp to C corp conversions, built-in capital gains. So all these are very complex tax issues which are, and I think SPAC listings are happening at a very high scale, like 500 million, 400 million. So all these, when the transactions are happening at such uh, a large scale, the complex tax issues are bound to happen, and we need to be aware that, okay, what are those tax issues around? Could be like, it could be taxation of the merger transaction, it could be transaction lose of the tax status benefit of QSBS to LO2, or it could be uh, as low as like whether the I would say yes, uh, founder lock-in of shares, as we discussed, compensation versus capital gain tax issues. So these all issues what we discussed would become again more prominent in the SPAC listing scenario, and this takes center stage. And as a advisor or as an Indian consultant, we need to help our clients. So as a live case study, we are working on one of the SPAC transaction, and I am helping one of the founder on this particular issue itself, that whether the earn out of consideration would be considered as a capital gain or uh, service income, and the stakes involved are as high as $175 million of the compensation, and the stakes are so high that founder is also considering whether he should relocate from US to UAE to mitigate his tax structure, so that in UAE there is no future tax liability. So the stakes are so high that for tax reasons, promoters are willing to relocate to a different country. So if we give the right advice to our clients and to the promoters and the founders, they would appreciate that. Okay, so this is what the objective of the session is, to make you aware that what are the tax issues that could come into your mind and how we can do. Obviously, they need research, and we cannot discuss all this at one time. But with the research, AI-based research, practical tools, and your experience, you can advise your clients in the right manner what these transactions are and how they should be taxed. So I think this is it from a overall point of view, and these are some of the resources to stay updated, like AICPA resources for the tax, accounting, FASB resource, which Ritvik just showed you on the live, that how you can do the accounting standard codification. So yeah, and some of the uh, things which I think Ritvik would not take away, would give his take on the overall sessions from an accounting and tax point of view. Then we'll take up your question. So over to you, Ritvik, now.
Yeah, yeah. Thank you, Manish. It was really a wonderful session of what you spoke about the taxation. So I think we all got appraised with the whatever the tax positions are. Thank you. And I'm taking this session forward. So Now the next session is about how we can be very much updated. You know, so what are there are certain changes happening rapidly, and how we can be more updated. So in India, when we see we there accounting standards and announcement publications which we keep on reading in it, and we keep abreast about what are the changes are. Similarly, in US also you can be updated by reading the Journal of Accountancy. Okay, then the tax advisor as well. So like there is another resource from the AICPA for staying current. That is the Mecca Institute of CPA. They have keep on publishing the notifications and something newsletters as well. So you can keep on reading about it. That is published by the ACPA. Then you have Journal of Accountancy. That is a flagship AICPA publication which publishes monthly and digitally on journalofaccountancy.com. It covers emerging FASB standards and their practical impact, IRS development, technology updates, and professional wide trends as well. That is freely accessible for any Indian CA building a US advisory practice. Okay. And they also publish the critical topics like ASC 842 implementation challenges for small private companies, that AI in audit, ESG reporting framework. Recently, we saw that the our institute is coming with a sustainable engagement assurance. Similarly, the US GAP they I think last month only they have started with this sustainable assurance engagement. And there is another tax advisor, the AICPS, that is also a dedicated tax journal, and that gives more detail about the technical publication that is available outside of primary source material. Monthly issues covering federal and state tax, cross-border planning, and IRS procedures. The AICPA practical guides and audit guides. There are certain industry-specific accounting and auditing guides as well, which are published for the healthcare entities, which are non-NPOs, construction contractor, investment companies, and others. These are the reference materials which the auditor we use in the present life case studies whenever any such kind of situation or any kind of the problems that come into in their daily life. Indian firms auditing US sector client, they should purchase and this maintain the guide relevant for their client industry. Then there are certain key standards like as we see we in India we have ICI which issues in India. Similarly, the FSB has set us GAP, AICPA sets gas auditing standards for non-published companies. We have the Institute of Chartered Accountant. They keep on regularly publishing the code of ethics, and now we have a revised code of ethics. Similarly, in AICP, there's ET section, which is stricter in small areas. There's financial internal audit clients, and they must be those should be studied to have a check on what are the ethics surrounding our accounting, everything, the best practices. So there are certain recommendations like a reading path for Indian CS advising US bound clients. That is, start your journal of accountancy, do deep dive into the tax advisors board, start updating yourself, subscribe to the FSB, the free in focus newsletters, then go into the industry depth publications, the industry publications also. So read those things and you'll get much better insights about the industry which you're operating. For the tax practice you should join the AICPA tax section. There is a Blue Jay as well. That's something privately owned and which more emphasis on the tax portion. And there is an audit readiness. You should keep on reading the study AUC sections, the founding auditing standards that govern any US audit attest engagements. Then there are certain key takeaways for Indian startups going to the US that we have discussed. Like we have to maintain the books of account as the accrual basis of accounting. The book should be gap aligned, so no deviation, anything from your gap. Otherwise, that will attract the regulators. Then deliver C code, which Manish spoke about, to the right entity, the setup of which entity you can set up. And it all depends upon your objectivity, what is your goals, where you should up, and whether it is a S Corp, C Corp, LLC. Then the taxation point also should be kept in mind while setting up your company. How to repatriate your fund from the, if it is a your company list, you have to set up a company outside India, then also there's a repatriation problem comes. So all that things should be in your mind before you set up a company. We talk about ASC 606 revenue recognition, which talks about the 5 steps model for recognizing your revenue. Then documentation as well. We discussed the documentation. That's a primary thing. The document has to be maintained. We given very much emphasis on documentation, because in audit you must have heard that whatever is not documented is not audited. So similarly, here is the documentation is very much important. And when you have any company in the US or any other company, so the documentation plays a key role to substantiate the transactions you have. You should have all your sales, purchases, expenses, the JVs, the cash book, bank book, everything with you, and that should be properly filed in your custody, the name of the entity to substantiate before it, if any, there's a tax issue, the tax litigator, tax regulators comes. So that is going to really help you. That will be a savior for you. Then choose the right accounting software. We discussed about the QuickBooks, we discussed about the Sage, Zero, then very AI-based softwares like Digits we have. Yeah. So the choosing the right software is also very much important depending upon the volume of transactions you have, how much do you want to automate. So whether it's a small business, large business, so all these things they will play the factor for choosing the right accounting software. Also, if you're operating in any other software, you have that migration facility as well. You can migrate your current books of account to any other software you want. Then next is something like you have now the next step is like you have prepared the books of account, but then you should engage some US qualified CPA to review your books of account or for the auditing purpose. Yeah. The transfer pricing documentation also plays a very critical factor here, which Manish spoke about right now, that about the how's the transfer pricing litigation. And so the arm length prices, you should maintain the pricing when you are having a transaction with your own subsidiaries and holding companies, and how you can be abreast with the latest learning, notifications, publications through the AICPA journal, FACB boards, Journal of Accountancy Tax Advisor. So we all discussed about this, and so I think these are all the solid things, the bullet points, and not just the bullet points. These are, if you can take it seriously, these are the things by which you can manage your books of account, how to maintain it accurately, how to keep yourself updated, how to your accounting standards can help you a savior in maintaining your proper books of account. Then the accounting aspects we discussed industry wise, how what are the something complications and the significant accounting aspects that has to be considered when you are operating in any kind of industry. Accrual and cash basis. Then there's a prepaid amortization. Those things also are very much relevant when you are maintaining the books of account in other jurisdictions in US, Australia, anywhere abroad. So I did not mention about prepaid expenses. So that thing was also that has to be those prepaid expenses that has to be recorded each and every month depending upon the type of uh, transactions you have, like prepaid insurance. So you need to book it in every month the expenses and reduce the asset part from that is sitting on your current assets. Then there is an amortization of the intangibles, any other thing. So those are the accounting concepts which we should be careful about when we are maintaining the books of account. Yeah, Manish, I think you can take up this section, top 10 mistakes Indian founders.
Yeah. So can you just scroll down? I just feel it.
Yeah.
So some of the key mistakes when the founders or the advisors make when they advise clients in setting up is that, as I said, choosing an LLC when the VC funding is the goal. Let's say instead of going for a C corp, you set up an LLC. So going a conversion later on would involve penalties and delayed election. So set up at the right stance firstly. Then if you're giving ESOPs to your founders, there's an election under 83B, which we need to make within 30 days of your ESOP. So that election, if not made properly, can also lead to incorrect tax treatment, or not the tax cost is being optimized for the employees. And also failure to file international reporting forms like FBAR 547 have penalties in the range of $10,000 to $25,000, which can be very significant. Other issue which we feel many times startups and their founders ignore is when they grant ESOPs to their employees, they do not take a 409 evaluation. They just grant on the basis of the funding round, or they don't have a formal valuation report. So this is one of the ignored area. And also they do not report their US safe instrument under the FEMA reporting laws for the Indian tax reporting, or under the Indian ODI, or under the India Foreign Asset Liability Schedule. So this is one also area. Then also founders do not do their pre-immigration tax planning, like mutual funds, PFIX. They all are very complex from a US tax point of view. So if founders are looking to relocate to US for funding and for business operation purpose, they need to manage their personal finances as well before they move to US as well. So these are some of the high level takeaways. And I think towards the end, what we would like to highlight, if you Ritvik, can scroll down, is that how we as a True Ledger as a firm are supporting many startup founders and companies looking to expand outside India. And we would be happy to partner with all of who you have joined us and who are looking to build a practice in the US tax accounting. We would be happy to partner in with you and interact with you for future collaborations and opportunities. We do have like a partnership model or a referral model in place where we can collaborate and interact with you and provide the white label services. Yeah. Any questions? We'll be happy to take. Yeah, you can close.
Thank you so much, sir, for the insightful session and practical guidance shared today. And a special thanks to CA Dr. Raj Chawla for organizing this wonderful session. Thank you all participants for joining us. Have a great evening ahead.
Thank you.
Yeah, thank you. Thank you, Raj sir, and thank you, Hitesh. Thank you so
Thank you
much.
everyone for
Yeah,
joining.
thanks,
Have a
Manish.
great weekend.
Have a great
Bye-bye.
day. Bye bye.